Greetings, and thank you for joining us today. My name is Brandon, and along with my Team 2 members Niharika, Dina, and Zubair, we're going to present today our strategic analysis on our company, Barnes & Noble. Let's begin with a brief company introduction. Barnes & Noble can trace its history back to 1873, when Charles Barnes started a used bookstore from his home in Wheaton, Illinois. In 1902, Barnes' son William took over the company as president, but sold his shares to the company C.W. Fullett in 1917. William took his earnings and moved to New York City, where he established a textbook wholesaler, Noble & Noble. The company renamed to Barnes & Noble and expanded, leading in customer service, textbooks, medical books, and used books. In 1971, the company was acquired by Leonard Riggio for $1.2 million. He expanded the store, offering up to 40% discounts on recent bestsellers, and by 1986, Barnes & Noble had grown to 180 outlets, including 142 college bookstores. Barnes & Noble was also the first to advertise, and consumers still remember some of their commercials to today. With sales booming, Barnes & Noble went public in 1993 and online in 1997. They have expanded by acquiring other bookstores, increasing their amount of superstores, and allowing consumers to buy books on an online platform. In 2003, the company also purchased Sterling Publishing, entering the self-publish business by purchasing the rights to publish classics at an affordable price. Barnes & Noble is currently a Fortune 500 company and is the nation's largest brick-and-mortar bookseller. As one of the largest operators of bookstores on colleges, maintaining long-term relationships with universities has been a long priority for the company. Currently, Barnes & Noble operates 638 bookstores from coast to coast, and the company is now looking to expand into the digital market to offer content around the globe. Let us begin our external analysis by looking at the 5 competitive forces and how these forces have been affecting Barnes & Noble, beginning with the risk of entry. Currently, the book industry has become pretty saturated. Consumers have many options on how they want to purchase their books. You can go into the brick-and-mortar store, look on the shelf, and pull it off and buy. You can go online, search for it, buy, and have it shipped to your door in 2 days. Or you can also go online, buy a digital content, and read it on many electronic devices. This has caused a very large shift in the intensity of rivalry for Barnes & Noble. Again, customers are now looking for the best price and have turned towards online services. Barnes & Noble survived their brick-and-mortar retail war with their opponent Borders, but now Amazon has come on the block and is the current leader in the book-selling market. This is due mostly because of the bargaining power of the buyers. Consumers are looking for the best value. Online retailers give customers the best value and offer much wider selection of titles to search, and again the ability to have it shipped to your door in 2 days. Continuing with the 5 competitive forces, let's now look at the bargaining power of suppliers. Barnes & Noble has a limited number of suppliers, and changes in relationships with key suppliers can affect sales and the company's overall financial condition. Currently, Barnes & Noble does not have any long-term deals with most of its suppliers. Making arrangements with suppliers will help guarantee Barnes & Noble has the merchandise on its shelf and content will always be available. Lastly, let's look at the threat of substitute products. Barnes & Noble experienced growth for many years until a substitute product offered you the ability to take your library anywhere. E-reader devices have been a growing trend since their introduction, and at first Barnes & Noble was at the forefront of this technology. When the Nook was first introduced, it controlled some 20% of the digital content market. However, due to lacking functionality, services, and development, Barnes & Noble has continually lost their market share. Barnes & Noble recently reported digital sales of $37 million in the first quarter of 2016. This is 28.8% less than the $52 million in sales made during the same time last year. Now let's look at the macroenvironment forces. Social forces refer to how changes in values, characteristics, or ideals can affect an industry. This has created some opportunities for Barnes & Noble, who can now offer certain segments literature they are trending towards. Currently, healthy living, how-to, and textbooks represent a growing segment of sales. Social forces have created obstacles for Barnes & Noble, and now the trend towards digital media. Barnes & Noble needs to rebrand their digital content to take back digital market share. Political forces are changes in laws and regulation which can significantly affect management. Regulating content laws for both published and digital products is important for Barnes & Noble to guarantee they are not breaking any laws. However, Barnes & Noble has been most affected by the regulations of its upper management, more specifically its board of directors. This past August, the board decided to let go of its recent CEO, Ron Brewer. Barnes & Noble's current CEO, William Lynch, is its fifth in 4 years. The board has put profits ahead of anything and has the power to remove senior-most figures of the company based on financial losses. This affects the overall company immensely. Leadership is very important, not for only their employees, but for consumers and investors looking for a strong company. Demographic forces are changes in characteristics of a population's age, gender, ethnicity, race, or sexual orientation. These changes give managers unique opportunities and create new threats. The aging baby boomer population represents a large segment, and as noted earlier, healthy living techs are representing an increasing segment of sales. The older and educated segment of consumers is Barnes & Noble's primary customers, and continuing to offer products aimed towards them must continue. Contrariwise, the younger demographics are using more online techs. Barnes & Noble must find a way to gain interest in their stores and reinvent their online store to gain back these young consumers. Now on to the global forces. Today, we've seen a huge increase in the world's global trade. You can order a product from anywhere around the world and have it conveniently shipped to your doorstep. In 2012, Microsoft invested $480 million in Barnes & Noble for international expansion. Barnes & Noble used some of this investment to launch its Nook device in the United Kingdom. Unfortunately, other retailers such as Amazon had a loyal following in the United Kingdom by partnering with bookseller Waterstones, a brick-and-mortar retailer within the United Kingdom. Barnes & Noble needs to do the same in using partnerships when entering international markets. Technological forces have been accelerating at a phenomenal pace over recent years. Constantly, new products are being introduced, rendering what was once state-of-the-art obsolete. Barnes & Noble has been impacted greatly by the changing in the world of technology. Books are not considered high-tech. However, technology has changed the way you can read and the way you can now order your books. You can either enjoy the physical book on your shelf or keep it on an electronic device. Barnes & Noble recognized this early and offered a website to order your books. The website helped Barnes & Noble win the book retail wars, but they fell behind on offering good digital content. Amazon's Kindle has been the #1 provider of digital content since its release in 2007. Barnes & Noble's Nook device was released in 2009, but by then many consumers had amassed a library on their Amazon device. The Nook has received mixed reviews, most notably sluggish performance and difficult user interface. Creating a better electronic reader system should be Barnes & Noble's #1 priority in meeting this highly paced technological world. Now onto the microenvironment force. The growth rate of the economy, interest rates, currency, and exchange rates are 4 primary economic forces. Recently, our economy has experienced a downturn, causing a decrease in consumer spending. The retail and digital industry is highly dependent on discretionary consumer spending. However, there are times in the year when consumers spend more. Barnes & Noble's business is seasonal. Sales are highest in its third quarter. Colleges and holiday business is significantly higher during this season, and Barnes & Noble needs to take advantage of this time frame. Releasing new products that consumers have been waiting for should be aimed during this time of the season. These release dates are controlled by the publishers and suppliers, so by partnering with Barnes & Noble, all parties will be able to achieve a better sales during their highest season. Let us finish the external analysis by looking at Barnes & Noble's industry life cycle. The industry life cycle model identifies 5 stages in an industry environment, starting with the embryonic, moving towards the growth, then the shakeout, then the mature, and lastly, decline. Barnes& Noble was in its embryonic state when it started in the late 1800s up to the 1960s. When Leonard Riggio purchased the mismanaged company in 1971, Barnes& Noble entered the growth state, being the first bookstore to advertise on television and offer discount books. During the 80s and 90s, Barnes& Noble continued to experience growth but had now entered the shakeout phase of the 2000s. Barnes& Noble survived this phase by expanding into college markets, partnering with food vendors like Starbucks, and offering a superior online bookstore when compared to other brick-and-mortar retailers. Currently, Barnes& Noble is in the mature stage of the industry. However, some would argue that they are actually in the decline phase. Barnes & Noble has been closing stores, but this gives them the ability to concentrate more on their digital market. Digital media and the devices we use to read them offer Barnes & Noble an expanding market to enter. By doing so, Barnes & Noble can continue to operate in the mature stage of the industry and maybe even go back to the growth stage. Now on to an internal analysis of Barnes & Noble. Barnes & Noble is the world's largest bookseller with a multi-channel strategy of offering both online and retail locations. Offering both paper and digital text, Barnes & Noble offers readers multiple options to enjoy their literature by focusing on three primary business units. Through its own publishing operations, Barnes & Noble has acquired the rights to publish classics and offer inexpensive versions. Its retail locations are located coast to coast and not only include Barnes & Noble stores, but also Dalton Bookseller, Doubleday, Bookstop, and Bookstar, which are stores located within regional malls. And lastly, Barnes & Noble's website offers both print, digital, and a selection of some 30 million out-of-print used books. Currently, Barnes & Noble operates 638 bookstores in 50 states and is a Fortune 500 company. They are open 7 days a week, average 26,000 square feet, and include cafes and offering comfortable settings where customers can sit and relax. Barnes & Noble's mission statement is to operate the best omni-channel specialty retail business in America, helping both our customers and booksellers reach their aspirations while being a credit to the communities we serve. Strengths for Barnes & Noble include a well-established brand, discount pricing, a broad product portfolio, and Barnes & Noble's college stores. However, Barnes & Noble has experienced recent losses due to weaknesses, including an inconsistent mission statement, dependency on their suppliers, and lacking of support activities. Losing nearly $1 billion to build their own e-reading market and device. Since 2012, Barnes & Noble has not invested money into research and development. Having a net loss for years in a row now, Barnes & Noble is operating mostly on debt and stockholders' equity. After the heavy losses Barnes & Noble experienced with their digital content, the company is hesitant to get back into the digital market. With the increase in popularity of e-reading devices and the expanding markets enjoying this technology, Barnes & Noble must re-enter this market. Back in 2009, Barnes & Noble again had a 20% market share of digital content, but since then their content sales have dropped dramatically. Recapturing this market share must become a priority for Barnes & Noble moving into the future. And now I'm going to hand it over to Niharika, who's going to talk more about the functional level strategy.
Thank you, Brandon. Managers at Barnes& Noble use functional level strategies to upgrade the efficiency and effectiveness of their value creation activities. Superior efficiency. In order to compete with the online market leader Amazon.com, Barnes& Noble had gotten into the online book selling business in the 1990s. This enabled the company to expand its national presence while increasing per book profits as online sales involved lower overhead costs, proving its superior efficiency. Superior quality. The management at Barnes& Noble tries its very best to ensure that its customers can rely on getting high quality services such as receiving books on time and with no defects. It provides many features and high quality services. Barnes& Noble sells many types of books such as trade books, mass market paperbacks such as mystery, romance, science fiction and other fiction, children's books, ebooks and other digital content, textbooks and course related materials. Superior innovation. Barnes& Noble has been able to achieve superior innovation by making numerous pioneering moves. In 1974, it was the first bookseller in America to advertise on television, and the commercials have also won many awards. The company took a groundbreaking step by becoming the first bookseller to discount books by offering New York Times bestsellers at 40% off publishers' list prices in 1975. Superior customer responsiveness. In order for Barnes& Noble to achieve customer responsiveness, it provides an important differentiating attribute that help build their brand loyalty for their customers. The company offers a textbook rental option to its customers through barnesandnoble.com. It offers its customers a suite of textbook options, new, used, digital, and rental, which has helped them to dominate the book selling market for years. Business level strategy. Business level strategy is used to plan to whom a company decides to serve, what customer needs and desires the company is trying to satisfy, and how the company decides to satisfy those needs and desires. Barnes& Noble was successful in implementing this strategy as well. Differentiation. As mentioned under functional level strategy, Barnes& Noble was able to differentiate itself from its rivals by providing superior efficiency, superior quality, superior innovation, and superior customer responsiveness to gain competitive advantage and profitability. It was one of the first to discount bestsellers, publish its own titles, offer authors self-publishing options, create superstores, and put coffee shops in its establishments. More recently, it has succeeded with selling toys and games. Barnes& Noble has differentiated itself from Amazon by catering to families and kids with Nook, which Amazon has not done much of in the marketing of the Kindle Fire. Market segmentation. A Nook tablet feature lets users record themselves while reading Nook Kids picture books, and this helps us conclude that Barnes& Noble always had a special relationship with families and kids. There are apps for kids and an expanded collection of comic books, graphic novels, and kids comic books on Nook. Nook offers the largest digital collection of Marvel graphic novels. Barnes& Noble has created a large fan base of women and avid readers by running a marketing campaign featuring best-selling authors. It grabbed attention from women by claiming that the Nook tablet can fit easily in a pocket or a purse. Corporate level strategy. Corporate level strategy involves choices strategic managers must make, such as deciding which businesses and industries a company should compete, selecting which value creation activities it should perform in those businesses, and determining how it should enter, consolidate, or exit businesses or industries to maximize long term profitability. Just like most businesses, it appears to be that Barnes& Noble has applied this strategy as well. Vertical integration. Barnes& Noble has established its own value creating activities to add value to its chain, making it worth more to the company and also to its customers. To compete in the electronic books market and adding value to its chain, the company had introduced Nook tablets that provide ease of use, many features, and flexibilities. Barnes& Noble has improved its value by offering a new digital bookstore and reading apps to give its customers the ability to purchase and read their digital content and access to their lifetime library on a range of digital platforms, including Windows 8 personal computers and tablets, iPad, iPhone, Android smartphones and tablets, PC, and Mac. Strategic outsourcing. Recently, Barnes& Noble has outsourced certain new technology functions by entering into an agreement with Bhagwan Cybertech, a global software products and services company. The company will take over a few new technology services, including cloud management, development support for new software. As a result of this agreement, Barnes& Noble had decided to close both of its Santa Clara, California, and Taiwan offices. They believe that outsourcing certain technology functions of Nuke will improve its performance. This transition is expected to result in annualized cash savings of approximately 13 million. Now Dina is going to talk about organizational arrangement.
Thanks, Niharika. I'm going to be talking about organizational arrangement. So, Barnes& and Noble has a centralized organizational structure, meaning that decision making is usually left for top level management, but day to day operations, that is the actual responsibility of just management in general, not only top level management. Barnes& and Noble also has a board of directors, which their responsibility is to oversee management's performance. So, like I just said, the day to day operations that management is assessing is then the board of directors' responsibility to assess how management is performing. Other things like strategic planning, financial and performance reviews, and things that have to deal with the CEO's performance, that is all basically overseen by the board of directors. As far as corporate social responsibility and ethics, Barnes& and Noble does have a corporate compliance program. So they have created a code of conduct and ethics, and they also maintain all of their accounting and financial information to make sure and review that it is, basically compliant with whatever the standards are. And another thing about Barnes and Noble, as far as their corporate social responsibility, is that they are pretty involved in the community. So they host approximately 100,000 annual community events worldwide. They also host an annual book drive and they donate books to children in need. And they also have a summer reading program. And throughout the years that they've had this, more than 1 million books have been in the hands of children due to Barnes and Noble. And they really do this because they want everyone to realize how important literacy is to children growing up. So I'm going to move on to the financial analysis of Barnes and Noble. And in the past, as you can see, I'm starting with revenues. So from 2007 to 2012, Barnes and Noble, their revenues increased by a fair amount each year, and we've actually seen in the past 3 years that they've seen a really large decline in their revenues. And so, in order to offset that and try to maintain some margin, they have significantly reduced their operating expenses. Other things that we're seeing with Barnes and Noble's current financial state is that in previous years, their cash and short-term investments made up a decent percentage of their total current assets, and not only that, but the amount of inventory, the percentage of their assets that were inventory was about 40%. And we're seeing in more recent years that cash and short term investments are making up a much smaller percentage of their assets. And meanwhile, their percentage of inventory is significantly increasing. And so it's up to about 50% right now, which is a lot higher than former years. And so the graph that I have to the right here, it's just going to show the number of orders that Barnes and Noble has done within the past 11 years. And you can really see that, kind of like I highlighted before, from 2013 to 2016, you're seeing, some decrease here. And obviously, that kind of makes sense, if they are not having as many orders, they're going to have more inventory. And if they're not having as many orders, they're also not going to have as much cash on hand.
Technology is a common competitor to companies relying on book or in-store sales. Barnes& and Nobles is originally a complete bookstore with employees engaging their customers while increasing their book sales. With the rise of technology, this concept changes greatly. Technology now offers online stores where things can be purchased and shipped to your door at the tip of your fingers. This erases the customer-employee relationships that bookstores often rely heavily on. In addition, the creation of e-readers and devices similar reduced the need to buy a paper book. This is appealing to consumer because it is less clutter, easy to purchase new books, and store them. Nook e-readers. Barnes & Noble reported a loss of $14.4 million for its most recent quarter, and sales fell to 6.6%. Their stock fell 61% over the last year. Barnes & Noble have attempted to compete in the world of technology by investing in Samsung Nook e-readers. However, competition from Amazon's Fire Kindle forced Nook sales to plunge 24.5% in the most recent quarter. Amazon sales skyrocketed as they were selling their Kindle Fire for $199, and Barnes & Noble responded with the $249 Nook color. For a consumer, this large price jump would pull their sales to Amazon rather than Barnes & Noble's. The Nook reader ended the year with a $39 million loss. CEO Ronald Bohr called the loss clearly unacceptable and is looking for improvement in going forward. Despite all the loss, Barnes & Noble is entering into a $30 million year contract extended its sale of the Nook branded tablets in their stores. Barnes & Noble is going to have to sell $10 million worth of each tablet each year to make up for any shortfalls out of its own pocket. In the Amazon rivalry, according to Porter's competitive forces models, Amazon is a strong competitive force and is regarded as a threat. It depresses Barnes & Noble's profits. Rivalry among these two established companies creates the struggle between them to gain the market share. With their cost conditions vary greatly, and Barnes & Noble's fixed costs are high, and they cannot cover them due to competition of the much cheaper Amazon alternative. This forces the sales volumes to lower and ultimately decrease profit. Hardware analysis placed on the physical cost of the tablets around $200, but the total costs, including marketing, packaging, software, and support, are much higher. In addition, Amazon is able to increase its competitive aspect by playing upon the bargaining power of buyers. They continuously offer sales and deals for their consumers. For example, last Christmas, Amazon bribed their customers with a 5% discount if they use their mobile price check app. They created Amazon Prime, something similar to Barnes & Noble's memberships, and their memberships already account for 40% of the company's domestic revenues. Amazon continues to push boundaries of technological innovation with their drones set for release in the next couple years. As Barnes & Noble continues to attempt to expand their horizons and the products/services they offer, they will have to endure to try and keep pace with Amazon. Global strategy. In order for a business to expand and prosper, Barnes & Noble needs to address its global strategy to expand operations outside the home country in a world where competitive advantage is determined at a global level. Starting off with staying up to date with technology, Barnes & Noble intends to increase their sales by pushing their corporation past only selling books and e-readers. The industry competitive structure forces them to step outside their comfort zone and create a business that can hit upon many different niches of people. They have entered the digital market and show that they have intended to continue a strong presence in this market. Although Amazon discouraged their sales electronically, Barnes & Noble have invested early into digital technology and communication devices when they began to be available. They recognized early that the company needed to shift into this digital market, and in 2009 they started their own e-book store available on Nook, iPad, iPhone, and other digital platforms. Moving on to focusing on target customers and including innovations. Barnes & Noble aims for their newer model of the Nook Color, to be the modest in style and focus mostly on reading to stand out against the other competitors for its main function. Their device compared to Amazon Kindles is easier to operate and aimed solely for people who want to read. They have also applied for a liquor license in New York bookstore for beer and wine. This is intended for future, possibly with implications of having a book signings or readings with liquor being sold. This is something innovative that is not offered at any other bookstores or any of their other competitors. Dependence on fewer suppliers. Barnes & Noble's a large portion of their products by the company is sourced from few domestics and international suppliers. In 2014, 5 largest suppliers accounted for 49% of the dollar value of merchandise purchased by it. Barnes & Noble does not have long-term arrangements with most of its suppliers, and as a result, there is no guarantee it will have the merchandise and services that is required. Finally, international presence. They lack international presence that puts the company at a setback for international profits and reduces the ability to grow and expand in a culture so full of globalization. Compared to its main competitor, Amazon, whose presence is strong throughout Europe and Asia and is still expanding. During Barnes& Noble's initial run with their Nook e-readers, they expanded to be able to serve outside the United States. However, when Barnes& Noble's terminated their commercial partnership with Microsoft, and as a result, payments through Microsoft account is no longer supported on Nook app for Windows was no longer available outside the US. I'm now going to discuss a few issues that Barnes & Noble needs to address in order to profit in the near future, starting with creating a superior website to serve all the needs of the customers with customer recommendations and additional loyalty programs. Lack of effective leadership in the company. There is also a decrease in profit margins due to an increase in competition. Amazon, who is their main competitor, has a hold over the book industry, lowers their profit margins on their products, allowing them to drastically lower their processes on their book. Barnes & Noble is not staying innovative or creating new products for their company. After the billion-dollar loss of the e-reading devices, the company is investing in them once again. It must be innovative.
Now that our team has identified some of the major issues that Barnes & Noble is having, we've come up with our final recommendation. And our recommendation entails Barnes & Noble finding another retailer that they could potentially partner with, and they can start with research and development for digital content. As we have mentioned, Barnes & Noble did have the Nook at one point. They were producing that, but because of the device's functionality and user interface, it wasn't a very successful product of theirs. So if they can partner with other companies, and maybe these companies have already conducted some research and development, they can leverage their findings and come up with a new product and new digital content. The other great thing about this recommendation is that digital content allows for the potential of a global market. So not only will Barnes & Noble be able to maintain some of the revenue that they are bringing in here in the United States, because at this point that is where the majority of their revenue is coming from, but they will also be able to bring in revenues from other countries. And just the last piece of this here is that the global market doesn't necessarily mean that they would be opening new locations or things of that nature, which would also be good because they wouldn't have to invest very much money. The other reason they wouldn't want to open new locations is that because we're seeing here, even in the United States, that physical locations aren't necessarily what's even bringing Barnes & Noble in cash flow right now. And as we've seen with Amazon and many other companies, it's very easy nowadays to do things online. And so that is why we are asking that if they follow our recommendation, they need to produce digital content and they need to do this online.